It's definitely unprofessional and it's borderline idiotic for anybody with organized capital right now to be ripping money in, because you don't know what the terminal valuation of a business is. Like at the end of the day, investing is like a line. It starts here with guys like Jason and it ends here with guys like me and Brad, say. And in the middle are these guys that are helping along the way, and it's all hot potato. But by the time the hot potato gets to us, there is a price, and that price has alternatives. Meaning, if you come to me and say, this thing is worth $10, and I say, actually, no, it's worth $2, because that other thing, which is better than you, is actually worth $5.
Potato, you put it on the scale.
There is a terminal endpoint to valuation, right? At the end of the day, there's a buyer of last resort, and that is the public market investor. And he and she has said no mas. That's what this chart says, no mas. You don't tell me that your thing is worth 50 times, 80 times, 90 times. It's worth 5.6 times. I saw something this morning from Morgan Stanley that said, if, however, you're a massive grower, 50% plus grower, there's 30 companies in the SaaS index that grow, but only 30 in the entire world that grow above 50%. You know what that multiple is? Just take a wild guess. 8.5. I mean, we're not talking 50 times, we're talking 5.6 or 8.6. So all of a sudden, the band is this.
To be clear.
So those games, to your point, are over. I mean, growing by 50% a year, for those of you guys that built businesses that do it, that is still very hard. You know, that's massive compounding. So the game is over. And the idea that there's a $250 billion, I think that that's a fallacy. Our investing focus, we've moved in the last 18 months to focus a lot on these things. Lithium mines, I mean, the stuff that we're doing seems insane. If you had asked me, would you be sweating a mine in India, you know, and sending our CFO and a partner to go and make sure the mine exists, I never would have thought that it's possible. But the reason is because of this chart. Because those trade-offs on dollars make so much more sense. To put money into an over-bloated software business comes with a lot of baggage. Valuation baggage, team baggage, technical cruft. All of these things have to get balanced. And so if you get a really cheap deal, you do it. You know, the companies that, you know, in your example, were all of a sudden run away with it and get all the money, think about the problem they have. Their growth is going to
Rate
slow.
limit, yeah.
Nobody grows at 500%
Right.
when you're at $1 billion.
Right.
You're lucky to grow at 25, 30%.
Right.
Okay? So when your growth is slowing and your valuation is outsized, like you were going to get to $5 billion, how do they attract more capital?
Right.
This is why this whole game is very complicated right now.
There was also something that took hold over the course of the last 2 years, specifically with respect to software, that this was an easy business. You just send us your data. I pop out a term sheet. It's formulaic, as though all software companies are created equal. And you guys asked a question last week on the pod, how many software companies are actually over $1 billion in revenue?
Yeah.
How many are over 2 billion? Well, we actually went and counted.
Oh, good.
Right? And public software companies over 2 billion in revenue, we got to 21. But what happened last year was you could be making dog walking software, okay? And somebody looked at your multiple and slapped 100x on it and said you were worth that, as though that was the equivalent of building a database that would disrupt the entire database market. So the thing that is returning to markets is something that we all do for a living called dispersion. Some shit's gonna be really great and the rest is going to be below the mean. And if you look at software, the history of software, right, is that there are very, very few companies that ever get to $1 billion in revenue. And so if you were slapping 100x ARR revenue or multiple on a company doing 50 million in revenue, it's highly likely that they will never see that price again, whatever you paid for that asset, because the dilution and the deceleration in their growth rate will absolutely eviscerate any return you have as an investor. And so when you're looking at this, back to your point, you know, not only are we looking at revenue multiples, but we're also looking at something like Snowflake and saying, now they're doing 15% free cash flow and expanding those multiples. All that stuff is critical. But, you know, Bill's talked about, you know, Benchmark's legendary for investing in eBay, and it was winner take all.
Oh.
Winner take all.
Yeah.
And I suspect that when you invested in Uber, you saw similar network effects. unfortunately, what you didn't plan on was Massa raiding Saudi Arabia, getting $100 billion of free money, and then blowing it out of a cannon into the market so Lyft and everybody else could do diseconomic things. The entire profit margin of Uber was competed away by stupidity. And you tweeted last week, and I noticed it because Jason and I may have a little something on the line here, you know, with respect to Uber. For the first time you tweeted after their quarterly earnings, maybe we're starting to see network effects show up at Uber. Because if you listen to the Lyft call, it was a train wreck.
For a decade, what that money did was it made those businesses what we call the consumer surplus business.
Yeah.
Meaning, what is a consumer surplus business? It's when all you win. Nobody else wins. The employees don't win, the shareholders don't win, the investors don't win, consumers win. You're getting subsidized rides, you're getting subsidized food delivery, you're getting some subsidized form of content, and there are these consumer surplus businesses that abound right now, that still exist, which are propped up by dollars that they're not being allocated because they're competitive. What is your attitude when you guys actually have a win? You do the job, company goes public, and you have the chance to distribute to your LPs. There's been a movement in Silicon Valley where some firms have said, you know what, guys, I'm going to hold this forever. I'm going to create permanent capital structures, evergreen funds. You know, if you foundation want a distribution from me, just tell me and I'll give you money magically somehow, et cetera, et cetera. What do you guys think about that versus just distributing and walking away, booking the win? And if you want to hold the stock, you just hold it in your own private account.
Well, I think we did a pretty good job over the last 6 months distributing out some gains, some realizations. We actually paid back our whole first fund. But in our second fund, we had about $120 million of a firm stock, and we were sitting on it because we believe in the company and still do, and we're still sitting on it. And that was like a $100 million mistake. So,
Right.
So I think, what's my attitude going to be from now on? Honestly, my attitude from now on is probably going to be distribute it.
So my first chance to actually return any real money to our LPs was when Slack did our direct listing. I held the stock. I didn't distribute it. The pandemic hit. I then distributed in sheer panic. And we left a lot of money on the table that I could have just booked the win for the LPs. And then from that point, I said, never again. I'll hold it for myself, but the minute that I get a distribution, if I'm in the business of managing money for other people, it's out the door when it's liquid. And I'm not going to I'll be happy to take a point of view for my own shares. But God, I felt so stupid. I took a 50% loss trying to be a hero.